Hey everybody, Scott Wertan and Honest Rate. Today, let's talk about the conversation around portable mortgages. Let's dive into a few things. So number one, what the heck is a portable mortgage? Number two, how would it work? And number three, is it something that's viable? So number one, a portable mortgage means that if this were to go through and be something that becomes valid. So I guess maybe let's backtrack. First and foremost, it's not a thing yet. It's just a talking point. So if it were to be something that goes through and it's valid, what it means is you can take your mortgage from your current home to a new home. And why are people talking about it? Is right now with a lot of homeowners that have gotten mortgages, maybe from 2020 up until 2022 that have extremely low interest rates. What are they going to do if they want to move or need to move? So the conversation is, let's allow them to take their mortgage with them. So the idea behind it is that it's going to help home affordability because people are supposedly not buying homes right now because they have a really low interest rate, maybe a 2.5 or 3% on their current mortgage, and they don't want to opt for something that's, 5, 6, 7%. So the idea is a theory to help homeowner affordability and to be able to buy new homes. So let's dive into the math and how would it work. So let's just go through some hypotheticals. So let's say right now you currently owe $200,000 on a mortgage and you sell your home after you pay any realtor fees, closing costs, expenses. Let's say you walk away with a net profit of $300,000 and you're going to go buy a new home that's $400,000. So what this would allow you to do is to take the $200,000 mortgage that you have and move it from your current property to the new property and keep your interest rate as is. Now, what you'd have to solve is, what do you do with the difference if the new home is more expensive than your current home? So if you owe two, you sell it and walk away with three, so you net 100, but you buy something for four, well, there's $100,000 difference. And where does that money come from? So I think that's something that would need to be solved in this scenario. Is that cash? Are you having to come up with an additional $100,000 in the down payment? Are there going to be, second mortgage options that you keep your first, but you got to go finance that difference? Or are there going to be some sort of grants or aid or something above and beyond? So that's the general gist of how does a portable mortgage work. Now, the real question is it going to solve any problems? Is it really going to help? And there's a few things that come to my mind as we go through this. So number one, these loans are about, it's only if it's a conventional loan. If it's Bill Pulte oversees FHFA, which is primarily Fannie Mae and Freddie Mac as far as this conversation goes. There's some other things that are in there, but it's really kind of nuanced. So you look at it and you say your four most popular loans are Fannie Mae, Freddie Mac, FHA, and VA. So for those of you that don't know, the Fannie Mae, Freddie Mac is the quote unquote conventional loan. And let's just say market share changes, but let's say they're roughly 50%, maybe 55% of all mortgages are under Fannie Mae, Freddie Mac. At least that's what I found using ChatGPT and Google. So if you say 50%, maybe even 60% of mortgages could qualify, it doesn't solve 100% of the problem. So if you have an FHA loan or a VA loan or a non-traditional loan, it doesn't apply to this portable mortgage situation if they become a thing. The second thing is that we've seen loans that were assumable in the past. And assumable means that, like, if you have an FHA loan or a VA loan right now, and someone can qualify to take your loan over, they could theoretically assume that loan, which means they keep the current balance, they keep the current interest rate. And it's a similar idea to the portable mortgage, except instead of you taking your mortgage with you, the buyer is getting to take over your mortgage. Now, what we have found is that assuming a loan is reportedly, traditionally, like one of the hardest things to do in mortgages. It is a full, what's called a manual underwrite by most servicers. It's extremely difficult to do. And at least from my 18 years of doing this, I mean, I've seen literally a handful of clients, like probably less than 5 that have told me they've tried it and were actually successful. So it's really, really, really difficult. So a lot of these things are good in theory, but they're difficult to do. Why? Well, I think it comes down to a few things. Number one, mortgages is a business, is a giant business. So if you look at just look at the largest mortgage companies in the country right now, and they're multi-billion-dollar organizations. A lot of their business is based off the fact that Americans traditionally, like every 5 to 7 to 10 years, make some sort of change with their mortgage. The percentage of people that keep a loan for 15, 20, 30 years is slim. And part of that change is folks that are moving. So whether or not you're upgrading and needing to find a bigger house, or you're getting relocated for your job, or you're downsizing. I mean, there's a million reasons. We all know life happens and we need to move. And that's part of the business life cycle. So if you take the vast majority of folks that are serviced in a loan right now have a really low interest rate. If those folks start to just port, I guess that would be the phrase, you port your loan from one house to another, then these giant mortgage companies, and heck, even the small ones like me, we're not doing the amount of business that we used to do. And I think that in and of itself becomes a barrier. So even if Bill Pulte comes out and says, we're doing this, and Fannie Mae and Freddie Mac say, we're doing this, you need the mortgage lenders and the mortgage servicers to be on board and to support it. And if this means that, they're going to lose hundreds of millions or billions or trillions of dollars, it's probably similar to the process of assuming a loan. So the process to port your loan over is probably not going to be the easiest, because these multi-billion and trillion-dollar companies might go out of business if everyone does that. So that's the idea on the business piece. Here's the other idea: is that, like, legally, when you look at your mortgage and you look at the legal note, and it's tied to this property. So it's a theory, but how do you unwind that? How do you have a legal agreement that's tied to this property and you move it to another property? Do you have to requalify? I mean, I'm just thinking out loud, and there's just a million things that come to my mind. So I think look, I like ideas. I like the idea that we're trying to solve for affordability. But I think portability of a mortgage seems far-fetched. Just my thought. So let's talk about this. Let's talk about affordability. And what are some of the things that could happen if mortgages become portable? And then also, what are some of the things that maybe some other ideas that could drive affordability? So if mortgages become portable, then I think the market probably goes bananas. You start to see people that are on the sidelines really jump in this idea of supply and demand. Supply right now of homes on the market is relatively low in a lot of markets. Where I'm at in Cleveland, Ohio, I mean, it's the supply is still pretty thin. So the demand for folks, if they can start porting their mortgage, how many people are on the sideline that just jump into the game? And what does that do for pricing? And that's the challenge with a lot of these ideas for affordability. Because if you have someone, I mean, if you have half the market as we talked about, in Fannie Mae and Freddie Mac loans, and a majority of them are on the sidelines because of their current low interest rate. If you get those people in the game, what are they going to do to housing prices? If a home right now is listed for 400,000 and it takes a 6.5% interest rate or 7% interest rate to get that home, if I could port over a 2.5% interest rate, what am I willing to pay for that property? Am I willing to pay 600,000? Am I willing to pay 700,000? And that's kind of what we saw during the COVID boom, is that as rates went down, values went up. In essence, it doesn't solve affordability. The first time home buyer, the person that is out there that doesn't have tons of money saved, how did they get in the game? Even if they have a portable mortgage, how do they get in the game and compete against someone who has a ton of cash? And to me, it becomes a race to asset gathering versus home affordability. So for my personal belief, I love the idea of how to incentivize affordability, but I do think things like a 50-year mortgage, things like a portable mortgage, unfortunately seem to be better in theory and may even fall on the line of clickbait. And in our, man, I don't want to be a Debbie Downer, but I just don't know how you truly implement those things. So I think what would be a better idea is looking at the subset of Americans who could benefit from an affordable product. And we have loans out there right now, whether it be USDA loans or VA loans or FHA loans. There's first-time home buyer programs. There's Home Ready and Home Possible. There are programs that are geared towards first-time home buyers. I would love to see us as a country lean into that. Lean into this idea of, if you're a first-time home buyer, or if you're below the median income in any given city, or county, or however we determine it, there's going to be further incentive to help those folks, because that would help home affordability. The problem is not that everyone has a low interest rate. The problem is that the current price, plus the current inventory, plus the current interest rate environment, plus inflation, plus wage growth slowing down compared to inflation, makes it really difficult for some people to buy a home, especially if you're a first-time home buyer, especially if you're newer in your career. So look, Bill Pulte, FHFA, Donald Trump, anybody and everybody who's in power, thank you for thinking about this. I love that it's on your mind. I would like to see you lean into more first-time home buyer ideas and see what you can do to incentivize that. Heck, last thought, back in 2009, when I bought my first home during President Obama, we had essentially down payment assistance. There were funds that we were able to get. There was different iterations. Some of them you didn't have to pay back. Some of them you did. But that, to me, in a similar rate environment, rates might have been a tad lower, but in a similar rate environment, I thought, as a first-time home buyer, was a massive game changer. So spend our money on things like that, probably more effective than 50-year mortgages, portable mortgages, and these crazy off-the-wall topics. If I can help you with anything directly, check us out at honestrate.com. Feel free to call me directly. Reach out to us. Honest Rate's phone number is 216-998-0123. Have a wonderful day, and I hope you learned.